Hello everyone, thanks for joining our half-year review of the UK energy markets. I'm Latif Fayaz, Head of Flexible Purchasing and Energy Strategy here at Northern Gas and Power, part of the Global Procurement Group. So I'm going to go straight into it for this presentation, and I'll share the screen with yourselves. We shall begin the presentation. Okay, so this is our half-year review, and today's agenda. We'll be discussing the year-to-date energy markets as well, what's been going on in power and gas for this year. We'll go into detail about power and carbon, gas, oil, and our outlook for the future as well. So let's get into the year-to-date, what's been going on over here. So we've got power and gas, power in blue, gas in green, power on the left axis and gas on the right axis in green. So at the start of the year, prices were pretty much range bound for the first 3 months, specifically power as well. There was very little major upswing or downswing. It was very much a flat line throughout that period until things started going haywards in March, end of March, when we had the ship stuck in the Suez Canal. And that's when we started seeing the rising of prices, when we traditionally have the start of the decline, the summer decline coming out of winter. However, we unfortunately had a second winter, and it was one thing after another in a short successive weeks. Second winter, low storage across Europe and the UK, which I'll detail a bit more later. We had a lack of LNG cargoes coming into Russia. A lack of LNG cargoes coming to the UK and Europe as a whole. Russia also, at this point here, bear with me. At this point here, you can see this dip, and this when it skyrocketed from here, when we're going to come out of winter, is when Russia prevented the additional capacity out of Ukraine, which was quite unexpected, but the start of Russia meddling with European gas supplies as well. We also saw carbon reaching 50 euros a ton as well during this period. So it was one thing after another in a very short space of time within those 3-4 weeks of what happened. We also saw the launch of the UK ETS. So this is part of the Brexit, where we're getting away from the EU ETS. And because there was a lack of information of how these two would be correlated, the market absolutely corrected itself and a near 90-degree drop of exactly what happened on power and gas prices. By the way, please feel free to ask any questions. We do have a question Q&A session at the very end. So please feel free to ask them throughout the presentation, and I'll answer those at the end. We also saw heavy maintenance at the back end of June. This has all been squashed back from the delays in 2020. 2020, of course, where every spring we would have the maintenance, but that was delayed due to coronavirus restrictions. That was all pushed back a year and all crammed in, and also into June. And that's why we saw prices uptick even further, where we had low storage in the first place and an even further lack of supply, not just for the UK, but the whole of Europe. And again, most recently, we saw Russia again stop the additional capacity via Ukraine. This seems to be a growing theme. We were expecting this to happen, but the markets jumped massively, touching 100 pence per therm and nearly £100 per megawatt hour for the winter 21 contract, which has been unprecedented, surpassing our entire winter as well. But the concern is, and why it rose that dramatically, is simply because our storage is so low, and the market's very nervous of going into low storage in the middle of July or end of June. And what are we going to be doing in the middle of winter as well? What is going to be happening to our power and gas supplies then? And that is the major concern, and why the market had just skyrocketed in the last few days. So we'll discuss power a little more in depth as well. So we'll look at the forward curves of what's been going on. So we've just discussed winter 21 of what's been happening. At the close of June, it was 35 £35 per megawatt hour. Of course, we know that reached £100 as well very briefly a few days ago. Summer 22 is again at a slight premium at 63, 65. But the key thing here now is to highlight the market is in backwardation, fully in backwardation, where the winter 22 is significantly lower than winter 21, which shows that this is a short-term issue, not a long-term issue. The same with summer 22. As well, how that, summer 23, on this graph is in backwardation as well, and that's already started to fall even further because we know there's a short-term issue, and the market has priced that in further out. And lastly, winter 23 for power is again even lower than the winter 22, which highlights it's a full backwardation, which has stayed consistent for considerable amount of time since the start of the year, really, where the market is. It's very rare that happens, but we're fortunate we're in this position. But it shows the increasing amount of renewable generation coming onto the market is being priced into here. So the more renewable generation we have, the lower the cost to generate our power, and therefore power prices will decrease in line with that as well. So that's why year on year we're seeing power prices decline. Our power supply mix, and this has been quite interesting how we've had, the main story for this is the lack of wind generation that we've had. We've had a strong bit in February, which helped cause prices to lower massively after an intense winter. However, since then, there's only been a brief spell in March, and at the end of March, and thereafter, we've had very, very little wind. Wind has really not breached close to 25, 30% of our energy supply mix, which is incredibly rare. So we're having a very low wind generation year, and that's really not helped power prices on the whole. Also to note is the use of coal here in orange in the middle of summer. Coal traditionally stops at the end of March, at the end of the winter season. However, we've seen coal make around 3 to 5% at times to help balance the grid, and that is pretty alarming. It's very rare, but of course, coal only has a short lifespan, only 3 years to go. October 24 is when we expect all coal generation to be completely phased out. Of course, it's already very minimalistic of how much it contributes to the UK power supply mix, but what has been interesting, the lack of supply or lack of wind generation has forced us to use coal again. Our upcoming interconnector projects, this is increasing, and by 2026, we're expecting the UK to be a net exporter of power, and it's because the amount of onshore and offshore renewable generation that we will be developing over the next 5 years. Right now, we're having the North Sea Link, which is coming online over here from Norway, as well as Electlink, which is over here, another one into France, plus the Viking Link, a first into Denmark. You'd have New Connect, our first one directly into Germany as well. North Connect, another one into Norway, another Fab Link again into France, and Gridlink as well into France as well. So Europe is becoming more and more interconnected with our power supplies, and that's because all of Europe, including the UK, is developing offshore and onshore wind and other renewable projects as well. So say a small company like Denmark has having far more supply of renewable generation than it requires. It now has the ability to export that into the UK should it desire. The same with Norway as well, where it's got excess hydro capacity that can send it to the UK when it no longer requires that. And vice versa, as the UK is becoming more and more energy independent, we're developing more and more renewable generation. There will be days where we can export power as well. And the fact that Europe is more interconnected means we can move that energy a lot more quicker. It's one of the lessons learned from 2020, where you had very high generation come March and April and no demand because we were all in lockdown, all of Europe, and there was nowhere for that energy to go. And you've seen that in your bills with higher imbalancing costs as well. It was a surprise for balancing charges to go up 5% alone, never mind the rest of your non-commodity charges. So that was the reason why that happened. And this increased interconnected Europe will really help power supplies and lower power prices for the very long term as well. We'll discuss carbon specific very briefly, and carbon has been pretty much the main driver for power prices increasing. Carbon prices were around 15 euros a ton at around April time last year, and they've since doubled to January 21, where they're in their 30s. As you can see here, they've just skyrocketed up, briefly touching 60 euros per ton over the last few days as well. But for some commentary, financial speculators have been the main reason for the increase in carbon costs. The EU has adopted a lot of ambitious targets as well. That's putting a price on carbon and also increasing the number of participants and the sectors being used for carbon trading as well. The also want to reduce emissions by at least 55% by 2030 compared to the 1990 levels. We also saw the launch of the UK ETS, which is probably the only major correction the market saw, which is why that drop is so significant. But then again, it recovered, again, hoping to get to 60 euros a ton, which it done. The last little bull run was the leaked draft proposal for the Fit for 55 package. And that was again highlighting in depth the increasing amount of sectors, the reduction in the amount of emission allowances going forward, and that's far more dramatic than people are anticipated. So that will be launched soon, but because that was leaked already, the market jumped on that and has already priced that in, taking carbon to the near 60s. Carbon was only projected to stay in the 30s this year. It wasn't. It's going to be another few years till it was supposed to get till the 50 euros a ton, never mind nearly 60. So carbon has surpassed most, if not everyone's, views of what carbon should have been priced at this year already. To gas now. Gas, will start with the forward curves of what's been going on in prices, and it's very much a similar picture to that of power, where the market is in full backwardation. Here we've already seen the winter 21 contract touch 100 pence per therm and come back down. And same with summer 22. That's not moved as much in that way, as much volatility, but it has still increased about a good 15%. Gas market obviously is backwardation, so there's a huge discount there for winter 22 compared to winter 21, over 30 pence per therm, which is phenomenal. But it shows the market that this is a short-term issue we're facing, not a long-term issue, because we're expecting an increasing amount of gas supplies coming into Europe. Again, same with the summer 23, how that's significantly lowest in the 44 pence per therm range, and the winter 23, that's at 53 pence per therm, so even lower than 22. And the main factor is we're going to see an increasing amount of gas supplies coming into the UK and Europe. So we're expecting Russia's Nord Stream 2 pipeline to come online by the end of September. We'll go into more detail about that later. We're also expecting Turkey wants to put another 20 billion cubic meters of gas onto the market as well. And now Egypt too, they've said they want to supply gas via Greece into Europe as well. So there's a serious abundance of gas coming onto the European market that we're expecting. Hence, we are seeing the market in full backwardation, and prices further out are even cheaper than the next 6 months. Added to that, our gas demand is significantly lower this year compared to 2020. Here you can see it's over the last few months, it really has been significantly lower when we're supposed to be refilling our storage here. Here you can see the increase was mainly due to a second winter and another cold snap, which happened in May as well. And this dramatic downturn was when we went straight from the winter into pretty much a mini heat wave. And that's why demand dropped down significantly and has started staying below 2020 levels. That can also be attributed to an increase in energy efficiency as well, but on the whole, it's still people working from home. Higher temperatures as well have reduced demand significantly on our gas system. Our UK gas supply mix. So this is where all our gas comes from. So the bulk of it obviously comes from the UK side of the North Sea, UKCS, continental shelf. The rest comes mainly from Norwegian pipelines, and usually around 30%, it peaked at 40%, just under, for LNG. And the concern now is if we were having up to 40%, even on a bad January, 10% of our gas supply mix was coming from LNG, and that is no longer coming to the UK, which I'll go into later. That is another factor why gas prices have been rising significantly. Also, we've not been able to import from the interconnect and going to France and the BBL into the Netherlands over the last few months, because they've needed that gas themselves to keep the lights on and to top up their storage. So our supplies have dwindled significantly of gas, which is why gas prices have risen so exponentially over the last few months. Our LNG imports year on year, so 2019 here at the back is how much we received. 2020 was a little bit lower, but still significantly high. And 2021, you can see how much lower it really is. We always have the March seasonal peak, and it drops in the summertime, but it really has been one of our lowest periods of LNG coming into the UK. And if that attributes to 30% of our supply mix, that's a real concern going forward. And there's a real lack of a view that this will continue. Well, we expect this to continue, the lack of LNG, and it's a greater concern for our gas supplies going forward. And the reason that is because Asia is prepared to pay a higher price for the gas than what they used to do. Previously, it was around 6 MMBTU for that the Japanese, and Northeast Asia would be prepared to pay. That's now close to 11.81. Same story, and that's why it's always slightly premier to the TTF, the European hub, as well, which is just at about 5, and that's now doubled to 10. But still, Asia has the highest prices in the world for gas, and that is where the LNG shipments are going right now, not Europe, because Asia is prepared to pay that price. How long that will last, we're not sure. But it's something that's been taken advantage of with Russia stopping its gas supplies into Europe to enforce its Nord Stream 2 pipeline comes online. Northeast Asia LNG Imports, who are the main absorber of all the world's gas being shipped. What was most interesting on this graph this year, China has overtaken Japan as the world's largest importer of LNG. Japan used to be the largest importer. That was because it shut all its nuclear power plants after the Fukushima disaster due to the tidal wave that have the tsunami that took it out, and they decided to remove most of their nuclear fleet and replace that with coal-fired generation. However, China's following suit, not necessarily with nuclear, but getting rid of its coal-fired power plants and moving that to gas-fired power plants. As a result, it requires a lot more gas, and that's why we've seen China really overtake Japan as the #1 importer of LNG, and they're prepared to pay the premium for this as well, which is why the UK and Europe is not receiving the LNG cargoes, and they're all going to China as well. UK storage, we had a brief bit of respite in March, but it still remains the lowest it's ever been in the last 4 years. Over here at this bottom, the darker graph is 2021. We had some respite in June, but it was, again, it's been taken away. The prices of the day ahead means there's no incentive for UK storage to be topped up. We've actually seen withdrawals of storage because it was more profitable to do so right now. It is very alarming going into winter with storage at such a low level. We are going to need to see record high injection over the next 3 months to get to some sort of winter level to be comfortable at. So it's a huge disparity in our stocks right now, and that is why gas prices have gone up so exponentially in the last few months, because we have been unable to fill up our storage. EU storage, well, the UK has the lowest storage right now at 16% full. This is in percentage full, and whereas Italy has one of the highest at 66% full, but the rest of Europe is still very much in the middle and not in a great picture in comparison to last year. For sure, where we saw single-digit gas prices at this rate, but here you can add 2 zeros to that right now. So it's still pretty glum across most of Europe. That they need to be a lot higher over the next quarter to get through the next winter. Penultimate, oil. Oil prices. So this is a weekly chart over the last year and a half. I should say. So there was a previous peak here at this line, just under $72 a barrel. And this graph here is when the start of 2021 of where we're at. So you can see the demand for oil and the price subsequently has risen pretty much in such a strong correlation. You would say in 2021 alone, the price has gone up by $27, almost 54% in these last 6 months. So it's a phenomenal bull run that we're seeing, and you can probably count on your hands the amount of times, amount of weeks oil has sort of retraced back, but it's been week on week an increase in oil prices. And that's largely driven by demand, which has outstripped supply over the last year. Also, so here you can have the lockdown, how demand had dropped down significantly, and there was a huge disparity in the supply. But ever since middle of last year, demand has pretty much been on top of supply, and OPEC has made sure of that as well. They've been restricting the amount of supply coming onto the market because they need to recoup their losses for last year. as well, which have been significant. So they're more than prepared to keep supply lower than demand and keep these prices in the 70s. There's always been talk of $100 a barrel, but there's also now discussions with OPEC of increasing the amount of supply they have, especially with Iran now back on the market, and they want to get their revenue increase as well. So it's going to be a delicate balance of how much supply will come into the market as well going forward. Recently, we had the OPEC meeting, which has been abandoned due to a lack of collaboration. They can't all agree on exactly what to do on maintain their supply cuts or increase supply, and that's not been decided and probably won't be decided for another few weeks as well. And our outlook. Finally, what's our view of the future? So some bullish factors, and it is mainly bullish, I'd have to say. Carbon is very much the driving force for the winter and gas power contracts as well. We've seen it go up exponentially, far surpassing our forecast of staying in the 30s, and that's gone up into nearly 60 euros a ton now. And that's maintains a major factor. So if carbon were to drop back into 30s, which I don't think is really likely, we're still going to see high prices for this winter. Russian supply, this is the key one. Russia's really holding Europe to ransom in terms of not booking that interruptible gas supply through Ukraine for July as well. So it's been May, June, and July that it's done so. We've also got maintenance on Nord Stream 1 and the Yamal pipeline, which is due in the next week. And from 1st of October, Gazprom will not book supplies via Poland and Ukraine for the year as well. So Russia's making it very clear it wants its Nord Stream 2 pipeline to be built as soon as physically possible. Although it is mostly built, it wants the approval process by Europe to get gas flowing through it in time for the winter, which Europe really needs. Russia knows it, Gazprom knows it, and they're prepared to profit from it massively as well, and hold Europe ransom, having high gas prices until it gets full approval for its pipeline as well. Storage, UK and European storage remains at all-time lows this year. Ours is currently, as you saw, 16% full and needs a record amount of injection to prepare for this winter going forward. So it's going to be a very tough 6 months. We only have one LNG cargo due in the next 2 weeks, which is very tough. It's very rare. And you can see it's hurting our gas supplies as well at present and going forward for the next few months. Asia continues to attract the majority of those LNG cargoes. They're prepared to pay the highest prices, one of the highest in the world right now, or on record. But it's also been interesting. We've seen Argentina and Brazil. They've experienced a drought, which means they traditionally have a lot of hydropower, thanks to the Amazon. But because of the drought, they now need to import gas for power generation. And as such, we've seen a huge surge in LNG demand in Argentina and Brazil, which is also taking away supplies from Europe and the UK because they're prepared to pay for it. Our bearish drivers, Nord Stream 2 really is the savior for the whole of Europe and the UK. That's got to be operational. We're thinking by August, definitely by the end of September, because that's when the Germans' elections will be. So you want this pipeline built before the elections so nobody else can interfere with it as well. But that will add 55 billion cubic meters to the market of gas, and that's much needed in there. The only way we could expect these winter prices to really fall dramatically is if we have warm weather, a very warm winter, as well as this Nord Stream 2 pipeline online as well. And that's the only way we're going to see prices decline significantly. And that's it from me. That's all from this presentation. I'm going to switch to the Q&A session. Okay, so we've had a question regarding Nord Stream 2 and why it is so significant in there. So I've briefly covered this as well. So it's Nord Stream 2 is one of the key pipelines now going directly from Russia into Germany. And with that, it's going to provide a lot of gas supply into Europe. That supply needs to make up for the lack of LNG cargoes that we have right now, and that's what's necessary to top up our storage facilities as well. So Russia knows this, Gazprom knows this. What we've seen in Russia has one of the highest levels of gas production that it's had, but also one of its record low exports into Europe as well. So because of that, Russia knows it's holding Europe to ransom completely, and it's just profiting from the high prices right now, and it's just waiting for its Nord Stream 2 pipeline to come online and then flood the market with all its gas that it has in reserve. That's just going to keep European dominance into Russia. It's a bit Cold War-esque, I would say, but that's why it's very significant for us. I think that's it for now. Thank you all for tuning in. If you have any questions, please feel free to email us on there. But that's all from me. We'll be doing another webinar in the next quarter as well, and obviously there'll be next week will be our weekly vlogs going forward too. So thank you all for attending. Cheers.